Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Exela Technologies stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Exela Technologies is a business process automation company. The company is headquartered in Irving, Texas, and was founded in 2017. It went public in 2015 and currently trades on the NASDAQ. It was created with the merger of Source HOV, Novatex Holdings, and Quinpario Acquisition Corp. Its services include workflow automation, digital mailrooms, print communications, and payment processing. It works with big banks, insurance companies, pharmaceuticals, and many more. In 2020, the company completed the divestment of Source HOV Tax, the company's tax consulting group, for $40 million to a private equity firm. The company's executives have over 30 years of business process automation experience. They have over 4,000 customers around the world. 60% of the Fortune 100 partners are with this company. Their global footprint is in over 50 countries, with over 1,100 facilities, with 19,000 employees. Let's get started with the model. This is a micro-cap company, 139 million market cap. They're trading at $236 a share, and they have 59 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company had positive free cash flow in 2017, negative in the next 3 years. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they also have negative net income every year. Revenue is the sales for the company, and they do have a lot of sales, peaking in 2018 at 1.6 billion. It's down to 1.3 billion in 2020. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. The difference between those two numbers is their gross profit. Then their operating expenses. Then below that is operating income. And they have negative operating income in 2020 and 2017. Below that is the interest they pay in their debt, which is pretty high. It peaked at 174 million in 2020. Then other income and expenses, then you have your pre-tax income, then your taxes. And the bottom line of the income statement is their net income, which is negative every year because it looks like they're still trying to grow their business and become profitable. The total addressable market this company's in is over $207 billion. They have $1.3 billion, and the biggest chunk of that is in banking and finance. The next biggest is in healthcare. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they have negative free cash flow every year, except in 2017. So they're using debt to run their business. They issued over $200 million of debt in 2017. They also received over $200 million of capital stock in 2017, and they've been issuing a little more debt each year than they've been paying off. Let's look at the capital structure. They have negative $900 million of equity, so that means their liabilities are $900 million more than their assets, and they have $1.6 billion of debt. Their net debt is also $1.6 billion. Their WACC is 9.1%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a negative value of this company. Since you cannot have a negative stock price, my calculated stock price is 0, so it's a sell according to the model. Only one analyst priced this stock, and this is from Yahoo Finance. Their price is $465. They're saying it's a buy. They've been saying it's a buy for several months now. I just had a difficult time valuing this stock and seeing the future of this company. I could be totally wrong, but I just never saw them getting to break even. I think their best opportunity is to get acquired. This is the company's stock price the last 5 years, and it appears that the stock price hit $30, but it was never this high. They did a 1-for-3 reverse stock split a couple months ago. That means if you had 3 shares that were $1 each, after the split, you would have 1 share at $3. Companies usually do a reverse stock split so they don't get delisted. Because if a company becomes delisted, less people know about the stock and less people buy it. So you can see the stock price has been really struggling over the years. This is the stock price for the month of March. It really shot up at one point because the company announced winning a $90 million data management contract from a major health insurer. The stock price almost hit $8 at one point, but as you can see, it came down quite a bit. It's not as low as it was before that big pop, but it has come down a lot. This is a pretty volatile stock. Their beta is 1.89, so the stock moves about 2 times the market. The stock has gone up 275% in the past 52 weeks, while the S&P 500 went up 51%. The 52-week low was 37 cents, the high was 7.82. And the stock is trading above its 200-day, but below its 50-day moving average. About 3 to 14 million shares are traded each day on this stock, so it's really liquid. Of the 59 million shares outstanding, 35 million are on float. 17% of the shares are shorted. That's a really high short percentage. So there could be a short squeeze in this stock's future. In the past year, this stock returned about 350%, while the industry returned 66% and the market 68%. But if you look at the past 3 years, it's a different story, where the stock has gone down 86%. While the industry went up almost 100% and the market 60%. In the past 5 years, their annual earnings loss is 35%. The industry gained 13%, the market 12%. But in the last year, their earnings grew 65%, while the industry only grew 6% and the market 3%. The top shareholder is HOV Services at almost 10%. Then the next one is 8.75%. The next is HGM, then James Reynolds, who works at the company, and the last is Pigeon Associates. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE ratio. Price to sales is stock price over sales per share. They're at 0.1, so investors are paying 10 cents for $1 revenue. That's a pretty low price to sales ratio. So the stock seems like a really great bargain with such a great price to sales ratio. Their last annual revenue was $1.3 billion, and their market cap is $139 million. That's why they have such a low price to sales ratio. If their market cap was $1.3 billion, they would have a 1 price to sales ratio, which is really good. Just to put this in perspective, one of their competitors, Pegasystems, which has a similar amount of revenue, actually was a little lower at a little over $1 billion. Their market cap is $9.5 billion. That's pretty mind-blowing when you think about it, how much more valuable Pegasystems is than this company. You might be thinking, this is a great deal, what an amazing price to sales ratio. You might be right, but you might be wrong. Let me give you an example. Say you went to the supermarket and you wanted to buy a steak, and the butcher said there's 2 steaks available, one for $15, one for $4. And you look at both steaks and you don't really know which is better, but they're both similar sizes. So you ask the butcher, what's the price to sales ratio? But you don't say that, you say, what's the price per pound, which is equivalent to the price to sales ratio. He says the $15 steak is $11 per pound, and the $4 steak is $3 per pound. You don't really know too much about steak, so you say, just give me the $4 per pound, it sounds like a great deal. You go home, you eat the steak, it's a bit fatty, a little stringy, it's not awful, but it's not like you really want that steak again. The following week, you go to the butcher shop, and they have both steaks again, and you say, let me try the $15 steak. So you buy the $15 steak, you go home, you go, wow, this is really good. It's not fatty, it's juicy, it's perfect. You really like that $15 steak. Let me give you another example. Say the following month, you go back to the supermarket, and the butcher says, Your favorite steak, the $15 steak, is on sale. We bought too much. It's half price. It's only $7.50 for the entire steak, $5.50 a pound. That's a good deal. You're buying a quality product at a discount. So the moral of the story is, just because something is cheap doesn't mean it's better. You have to look under the hood. Price to book ratio is stock price over book value per share. They have negative equity, so they have negative price to book. So we can't look at the price to book. Their return on invested capital is negative 2%. That means for every dollar they get through debt and equity, they lose 2 cents. Plus their WACC is 9.1%. So they obviously need to turn this around at some point. But they are a young company, so maybe they have a growth plan in place. Interest coverage ratio is EBIT over interest expense. They have negative interest coverage ratio. ROE is net income over equity. We can't look at that because they have negative net income and negative equity. Their current ratio is current assets over current liabilities. They can cover 70% of their current liabilities with their current assets. And their current assets are $68 million of cash and $207 million of receivables. So the company appears to be undercapitalized. They had negative $45 million of free cash flow in 2020. They have negative $131 million of working capital, so they have negative $177 million of funding. They're going to need more debt or equity to run their business over the next 12 months. These numbers are as of their 12/31/2020 financials. They did raise $27 million this month through a private placement offering. These types of offerings dilute the current shareholders. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 24 companies in the same industry as XELA. If XELA has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in every single ratio except price to sales. So to summarize, I have them trading at nothing because it's really hard to value this company. They seem to be really struggling. It's interesting they're bringing in so much sales, but they cannot convert any of those sales to profits. Maybe they have a plan in place that I'm not seeing. Plus, they did a 3-for-1 reverse stock split. A reverse stock split is a sign of distress. So all the signals are there. I could be wrong, but all the signals are there. I rank their free cash flow as 1 out of 10, their revenue 7 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.